Telephony services provider 8x8 sold off in January after an inline earnings report. Stocks come all the way back. CEO Bryan Martin's here to talk about it. Welcome, Bryan.
Hi, thanks, Greg.
All right, stock got shellacked in January. It's come all the way back. 2 weeks ago, you actually missed by a penny on the bottom line with the earnings. Didn't really affect the stock. It popped. So what's going on here?
Yeah, the company is growing very rapidly. March is our fiscal year end, so we announced top line growth of 25% for the fiscal year versus the previous year. If you carve out, we still have a little tiny residential base, but 98% of revenues from business services. Business services grew 32% year over year. So this is a growth story, and the reason we missed on the bottom line is sales were so phenomenal in the March quarter.
All right.
Pay all those commissions.
But what's driving it? Are you stealing share from somebody, or is it just growth in the overall economy?
No, we're a cloud telephony provider. We're a subscription-based alternative to the old Nortel and Avaya types of systems. It's all delivered via the cloud. 50% of our businesses come to us from AT&T, Verizon, or Quest, or CenturyLink these days, wherever they're located. So that's primarily, we're moving them from the copper circuit switch world into the world of IP.
So is the whole pie growing? I mean, is Vonage growing as well, or are you taking share from Vonage?
The whole space is growing between 20 and 30%. There's FCC data out that service providers like us file every year, and the space grew 24.7% year over year. So we're growing right in line with how the space is expanding.
And your gross margins grew as well in the last quarter, from 68% to 71%. A lot of people on the street weren't expecting that, and they lauded that. That's probably what drove the stock.
I think a lot of people don't think it's sustainable either. And that's the question I'm getting here in the city this week. We had GAAP service margins of 80%, which is something we've targeted for a long time. We told the street we were going to do it 6 to 9 months ago. We did it, and now the question is, can you sustain it? And we've told everyone we can. We think it's very sustainable. Well,
you also told everyone on the street during your conference call that you're going to be shopping. You have about $52 million in cash, no debt. So what are you going to buy?
Yeah, so we're now starting to expand this year into the UK. We're going to expand into the Asia Pacific region. One of the things that looks very strategic to us is potential partners, possibly some acquisitions, to actually put some feet on the street in those markets and not just service our customer base in those markets where they have employees, but actually get some new local organic growth out of those markets as well.
Well, here's an Asian partner for you. What's going on with Softbank?
Softbank is one of our newest partners. We are licensing them some data center technology that they're going to roll out in Japan this summer. They pay us on a subscription basis. They charge their customers, and we just get paid as a function of how many customers they put on. It runs on a vBlock, which is it's kind of a modern mainframe, Cisco, EMC storage, and VMware virtualization. And we tie all of that technology together with software that we've developed.
Well, they're doing some shopping here in terms of Sprint. Why don't they shop for you? They don't have to be a partner. They can be your owner.
I think they're very busy, from what I can tell, with that acquisition, but they're a fabulous partner, very disruptive in Japan. They are a fast-moving player, which is what we love. 8x8 still moves a little faster than them, but they're right behind us. So hopefully there'll be some expanded partnership as we go through the year.
All right, thanks a lot, Bryan.
Okay, thanks, Greg.
Thank you for watching The Street.